David Hertel in for Elias. The Bank of Canada increased their benchmark interest rate last week to the dismay of many who are already struggling with current interest rates. The rate increase, which went to 4.75% on Wednesday, is the first time that the central bank has raised its rate since January, when it had originally signaled that it would conditionally pause rate hikes and see if it had done enough to bring down inflation. Joining me is Terry Kilakos, host of the Real Estate Show on CJAD 800. He's a real estate broker with Northeast Real Estate and Mortgage Agency firm. Terry, thank you very much for coming back on the show.
Absolutely.
So, Terry, we spoke last week and we were talking about the high vacancy rates of business office space in Montreal, in downtown Montreal, and we had just gotten the news that the Bank of Canada was raising the prime rate. Now, the dust has settled, so to speak, but a lot of us that have variable rates and looking to renew their mortgage or looking to buy a house, I mean, this is just some of the effects that a raise like this is having. This is wreaking havoc with a lot of people that had already trouble making ends meet. First of all, it's been a while. It's been a few days now. I mean, what is your take on the why? Why did the Bank of Canada feel it had to do this at this juncture?
I was anticipating that the Bank of Canada was going to make an increase next month. But because inflation was announced last month, and it blipped up a tiny little bit. The government came back and they said, "Well, it's not a big deal. It's considered stable, but it wasn't heading in the direction that they hoped, which was down." So because of that, they decided to increase it. Now, my concern is that next month they're going to do the same thing because the next increase after that they would be doing, the next meeting they would have would only be in September. So I was anticipating that they were going to make it go up, next month, not this month. It's unfortunate that they did it. I think that inflation was heading in the right direction. It'll continue to go down. By the end of this year, I think we'll probably be sub 4%. So I'm not happy with the decision, to be perfectly honest with you.
Oh yeah, you are against this policy increase.
I am against it because, like I said, I mean, things were moving in the right direction. They want to accelerate things a little bit, so thus they increased it. But we'll see, what the effects will be, and we'll see if they're going to do another increase next month. If they don't do another increase next month, I think I'm okay with it. But if they end up doing another one next month as well, then we're going to have, a 50 basis point increase over a 2-month period, which is it's not ideal.
All right. So the primary reason I wanted you back on the show, Terry, is for those of us, a lot of our listeners have a mortgage. Either they have a variable rate or they have to renew in the coming months. A lot of stress, a lot of concerns. Any strategies, any advice we could go through for people having these tough decisions to make over the coming months?
So the really quick fix would basically be to reach out to your mortgage broker, or to reach out to your bank and see if you can convert that variable rate, which 99% of the time you are able to do. So you could convert the variable rate to a fixed rate. If you're going to be converting it at this point in time, you're probably going to be looking at a rate that's going to be somewhere sitting in the 5% range, maybe a little bit under 5, in the 4.9, but it's going to be about there. Typically, you're going to be saving over 1.5% off of your interest rate just by making that move, which will ultimately end up dropping your payments down. Now, the other option that you can look at doing is, if your mortgage is coming up for renewal in the short term, you could look at restructuring that mortgage and, again, maybe taking a shorter term fixed rate, 2 or 3 year, and then you can consider increasing your amortization so that way you can offset the fact that you have that higher interest rate. So, for example, if you were originally on a 25-year, now you're down to a 20-year amortization, you have the flexibility of being able to increase it up to 25 years and in some cases even 30. It's not ideal because obviously, we want to make sure that mortgages get paid off quickly, but we also don't want, customers don't want to be put in a position where they're going to be choking every month. So doing something along those lines would drastically reduce the monthly obligation that you have, thus freeing up cash flow.
Interesting. So what if a person or a family, they have to be on the market, they have to buy, and obviously some people will hold off, but sometimes you just have to. And you're in the market. I mean, what's your strategy? I mean, variable, fixed 3 years, 5 years. I mean, how do you tackle that?
Typically right now, primarily for the fact that, for qualifying purposes as well, if you're going to take a variable rate mortgage, to qualify for a variable rate mortgage, it's a lot more complicated today than to qualify for a fixed, whether it's a 3 or 4 or 5. My advice to people is to take a fixed, but you take a fixed rate mortgage for only 3 years. So that way it gives a chance for the markets to adjust. Everything, comes down hopefully in the next year or two. And that way you have kind of the best of both worlds. You have a lower monthly payment, plus you have the ability to either break that mortgage without paying huge penalties, or you have the ability to set up to basically have that lower payment and come to term, in 2-3 years, and hopefully interest rates are going to be lower at that point in time.
I saw in the press this weekend a strategy I'd never heard of before, but actually there can be sometimes a way for a buyer to just, instead of getting their own mortgage, to take over the mortgage of the seller and being able to benefit from the older and lower rate.
Yes, it is a strategy that's used. You can do that. It's not all mortgages that are transferable to new buyers, but it is a strategy that we use here as well. If a customer comes in and that mortgage is transferable from one person to another, you basically assume that mortgage that the other person has, and of course you're going to have to increase it to compensate for the extra amount, and then the extra amount that you would be taking, that would be at the new interest rate. So that is a strategy that could be used. It's not very common because a lot of mortgages are not transferable. But if you are selling a house and buying another one, the other thing that you could consider is actually transferring your existing mortgage and blending the existing mortgage that you have with the new mortgage that you're going to be getting, which would translate to a rate that's significantly less than what you would normally have had.
Very useful advice, Terry. Appreciate your time as always.
Anytime. Have a great day.
You too. Terry Kilakos, host of the Real Estate Show on CJAD 800, real estate broker with Northeast Real Estate and Mortgage Agency Firm.